This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 383 was produced on July 5th, 2023. I'm Eric Townsend. JDI Research founder Juliette Declercq returns as this week's feature interview guest. We'll discuss why Juliette thinks we're in an immaculate disinflation and what she sees on the horizon for markets.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, July 5th, 2023. The S&P 500 was up 152 basis points, closing at 4484. We'll take a closer look at that chart and the key technical levels to watch during the post-game segment. The U.S. dollar index up 37 basis points to 103.35, but still deep in consolidation in the 6-month range. The August WTI crude oil contract up 321 basis points, closing at 71.79. We'll take a look at that chart in the post-game. Gold up 26 basis points to 19.27, but remains in that consolidation for over a month now. Copper up 134 basis points, closing at 377, but continuing to consolidate since putting in its swing high last month. Uranium also down 54 basis points to 55.75. Prices stalling week over week after several strong months. The U.S. 10-year Treasury Yield up 17 basis points to 3.90. Stone throw away towards that 4% number. The key news to watch this week is the Friday's jobs numbers. And next week, we have the CPI and PPI inflation numbers, the Bank of Canada monetary policy report, and the University of Michigan consumer sentiment. This week's feature interview guest is JDI Research founder Juliette Declercq. Eric, why did we invite Juliette back on as a guest this week?
Well, Patrick, Juliette is a listener favorite, and it's been quite a while since we had her on the show, so we wanted to get her back and get her perspective on these interesting markets.
Eric's interview with Juliette is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is JDI Research founder Juliette Declercq. Juliette prepared a slide deck for today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button above Juliette's picture that says looking for the downloads. Juliette, it's great to have you back on the show. This is our first interview of the year, and I know that you've had some really terrific calls this year. So let's start by going through some of your recent analysis and recommendations.
Yeah, sure. Thank you very much for inviting me back, Eric. Well, here we are, midway through 2023, exactly, actually. And do you know what I see? Basically, headline inflation is vanishing in a puff of smoke, and there is no hard landing, no landing, in fact. The rise and fall of the pandemic-induced price roller coaster was, well, that's what I firmly believe it is, a perfect response to the Canadian ADAS, which is basically aggregate demand, aggregate supply model. And that is the very reason I could call for Immaculate disinflation all the way back in September 2022. See, in the end, those hours sitting on a bench at uni, learning about macro models did pay. Here is how it works. And you can pick the first chart in my package. That is simple like supply demand model from Keynes. And the supply curve is basically convex, which means that firms need increasingly higher prices to increase output when spare capacity is exhausted. And in contrast, the demand curve is concave for products with inelastic demand. In other words, if you struggle to find alternatives, you will pay more. And on that, think of European energy in 2022. What happened in 2021 is that Keynes' prophecy cooked up a perfect storm. the negative supply shock combined with a positive demand shock to force prices all the way into a new equilibrium on the very steep or inelastic parts of both the curves. Spare capacity, as we all know, was limited and demand was inelastic. We had a lot of cash, but we couldn't blow it on services. So while global output only edged up in 2021, it sent inflation through the roof. On the chart, it's going from like P0 to P1. What happened next was about what you would expect. Everyone on the supply side suffered a massive bout of FOMO and started stockpiling like crazy. And when I'm talking about stockpiling, I'm talking about inventories of raw materials, finished products, but also workers, and everything hit record levels. And that, as I argued back then, so last year in September, turned the pandemic famine into a feast. The problem was that it was right at the time where nobody wanted to eat anymore. After months of piling goods at home, they wanted to dance. So I argued the initial negative supply and positive demand shocks would reverse, leading to Immaculate disinflation. That is, a resumption of the initial burst of inflation with no macro drama. Price pressures would, in other words, subside, eventually with output and employment practically untouched. And that's pretty much what happened. So looking onto chart 2, you can see that the record inventory buildup pulled a U-turn. You can see on chart 3 that extreme geopolitical tensions peaked pretty much in September last year, and that collapsed the premium, the geopolitical premium on commodities back to fair value. And in the end, you can see on chart 4 that a supply-demand imbalance mirroring the COVID shock turned tremendous manufacturing inflation into actually manufacturing deflation, according to the last PMI numbers. So here we are. Goods price pressures have largely evaporated. If we consider last week PCE report, we can see that the Fed's preferred inflation gauge, which is the PCE deflator, dropped to 3.8% year on year in May from 4.3% in April. And if you look at the 3 months on a 3 months basis, we're actually at 2.45% annualized, which is actually approaching the 2% target.
Okay, so the narrative rightly called the inflation trends, but you're saying that today the real question is not that inflation, but what scars has that inflation left on the Goldilocks economy that we had before?
Indeed, and that's obviously the crucial point going forward for the Fed and generally for all central banks, and obviously for what matters to us all, which is asset prices. So if you're taking chart 5, you can see that the initial headline inflation shock spread through wages to domestically set prices. So considering core services ex housing, which is Powell and market's favorite gauge, we've been running around 4.5% year on year for the past 18 months. And we only just recently dropped from 5% to 4% on a 3 months basis in the past quarter. I think we can say with good credibility that if the budding drown trend persists, the Fed will likely stay put and pat themselves on the back for tightening policy enough. So we're definitely close to the end of the rate hiking cycle. But really what's interesting is wages. And surprisingly, given how key future wage settings will be for the outlook, it was a subject that was covered in Sintra, so the ECB meetings in Sintra by the Bank of England, Silvana Tenrero. Now, she's got a notorious dovish bias, but with that in mind, she still had a really good argument that a central bank should react not to the initial price shock, but only to the spillovers to wages and domestically set, and that's mostly services, prices. I'll quote exact words here because it's exactly the way policymakers will react in coming months. So it really describes central banks' reaction function in the future accurately. She said, quote unquote, if workers try to resist a fall in their real income by making higher nominal pay demands, and firms try to defend their real profits by raising domestically set prices, real income resistance can lead to nominal inertia and delay the return of inflation to target. In other words, while I was right on the initial COVID price shock vanishing, price pressures persist due to the classic lagged second-run effects on services prices and wages. In other words, companies are resisting lower profits and workers are resisting lower real wages. And because of continued strong aggregate final demand, they both succeeded. Now, I anticipated this would happen from Q3 last year. And the reason is that paradoxically, global manufacturing weakness and headline disinflation is, and that obviously wasn't always the case, but this time it is reflationary. Why? Because lower goods and resource prices have been a blessing for a large DM services sector, which basically benefited from spectacular aggregate personal real income gains, and hence the breathtaking repricing of the 2023 recession risk to date. As an aside, that's obviously the reason the manufacturing leading indicators have been so spectacularly wrong in helping to call the global cycle. This time, weak manufacturing strengthened the services sector rather than being a leading indicator. Traditionally, manufacturing drives service growth because it's a highly cyclical sector. So you can see for yourself on chart 6 that real income gains that mirrored the loss endured in 2021 and 22 caused a tremendous global economic rebound, which was compounded by easing financial conditions as we priced out immediate recession risk.
Okay, so you're effectively saying that weak manufacturing and disinflation are the probable reasons for the repricing of rate cuts that I guess have now become rate hikes.
Yeah, that's right, Eric. And you can see on chart 7 that, just a few months back, we had like 100 basis point plus spread between Fed funds and twos, which traditionally forces either cuts or a recession if the Fed cannot cut. And this time it was a red herring. Effectively, you can also see on chart 8 that the fantastic services sector recovery in 2023 allowed firms to rebuild profits opportunistically by keeping services prices charged sticky despite much lower input prices. And you would actually find the same is true if you're looking at like PPI versus CPI charts. That would tell you exactly the same thing.
Right. So this covers clearly why consensus started 2023 totally wrong-footed, and it indeed explains the 2023 global activity bounce. But your expertise is the future. So what happens next?
You're right. Obviously, it's all about what happens going forward. And what happened on what happens next? A first bit of information came through just last week through the June flash PMIs, which actually started to hint at a peak in final demand and potentially renewed services disinflation. In fact, you can see on chart 9 that firms are increasingly having to pass supplier price falls to boost their sales. And that output price inflation, which is in orange on my chart, has actually started to hedge lower again after the early 2023 slight rebound on the back of a much stronger activity. More importantly, though, and that's really the subject of this week, fresh out of the printer, JDR Research report, the real key to the outlook is wages. Why? because on the corporate side, the pricing headache comes less from output prices, which are driven by firms resisting lower profits, and more from sticky input prices due to the persistent wage pressures. And you can see on chart 10, and again, that's using fresh June flash PMIs data, that the cost burdens is still, for companies, is still far above pre-pandemic averages.
I'm assuming that wages feed right through real income as well, which is the other reason why getting their forecast right is absolutely crucial.
That's exactly the point, Eric. And the thing is that much like the traditional supply-demand curve we talked about earlier, real wage inflation is also a non-linear convex function of spare labor capacity. And that would be like the equivalent of the Phillips curve that many are talking about. In plain English, that means that real wages really start trending higher when you run out of spare workers or when unemployment hits the Nehru. And that basically forces firms to bump up pay to lure workers from other companies. The issue here is that where we had COVID temporary shocks before, it's not the case for the labor market globally. So the labor supply shock is actually turning permanent for the labor market. You can see that on chart 11. And the reason is simply that baby boomers are no longer just aging, but they're actually retiring en masse. So structurally, this is shrinking the labor force. We already have like 2 million workers missing in the US from the pre-COVID era, and this is actually going to worsen. So as a result, the US jobs workers gap, which is the difference between labor demand and labor supply, which I'm charting on chart 12, has hit full capacity in December 2022, and it also continues to hover around zero. And obviously, it is pulling real earnings expectations higher in a catch-up move to what happened in 2021 and 2022. And that's the light green line on my chart, on chart 12, which is coming from like different leading indicators in the Conference Board survey. But unfortunately, or perhaps fortunately, because we should all wish for real income gains, this is not just a US narrative. And in fact, the old age to working age population ratio will likely explode in most of the OECD in coming decades. And that's something you can see on chart 13. And the obvious macro effect of that is that is reflationary, because we will see tight labor markets and rich retirees supporting real income and spending. So tight labor markets basically support real income for workers, and retirees are the one with the wealth. And so therefore they don't have to squeeze their spending, which overall keeps aggregate demand much more supported than what we had pre-COVID. And in fact, tighter than expected labor markets and sticky wages are the reason why the 2023 rebound has even exceeded my wildest and deeply out of consensus 2022 forecast. And that's also the reason I've been, utterly right on stocks, but actually lost on fixed income. The point is that in hot labor markets, workers tend to use their strong bargaining power to recoup lost purchasing power. And as a result, increased wage demands have followed the 2021 burst in short-term inflation expectations in the US. And that's with a pretty reliable, across the world, lag of 9 months between higher inflation expectations and higher wages. However, the usual 9 months lag between the former and the latter means that automatically and mathematically, 2023 is seeing a strong payback for the 2021 COVID supply shock hangover in the US and 2022 energy supply shock hangover in Europe. With the original inflation shocks in the rearview mirror and short-term inflation expectations normalizing, what we're actually seeing is the recent wage gains are lifting real incomes and fueling hopes for increasing purchasing power, which overall is supporting global consumption.
Juliette, I love this chart. Do you have similar ones for other DM countries?
I do indeed. So if you're looking chart 15, which is the same chart for the Eurozone, there you can see that the wave of pay rises is yet to break for negotiated wages, but collapsing inflation expectation should see wage gains retreat in H2. If you're actually considering the overall cost index, labor cost index, which is on chart 16, you can see that we already started to cool in Q1, but obviously the ECB must gain conviction on further downside before shifting its hawkish stance. If you look in the UK, which is chart 17, you can see that wage growth there is living a life of its own. In fact, it's taking its cue from still strong headline inflation rather than falling inflation expectations. And this is obviously worrying, and it has worried the Bank of England this month, because it forms the premise of a wage price spiral and literally suggests that the Bank of England remains far behind the curve. So you should wait before going full on long gilts. And you've got the mirror image in Japan on chart 18, where workers have not put a fight. And despite the sharp losses in real income triggered by the exogenous burst of global inflation, they're not insisting on nominal wage increases. So if you consider Tenrero's reasoning from last week Sintra meetings, the BOJ has actually been able to stay put and is right to do so and let the yen weaken until wages actually start to pick up in line with consumer inflation expectations. So apart from Japan, the opening act of the global disinflationary process has largely been a pleasurable ride, indeed stabilizing prices, but continued strong wage gains. Again, what is there not to like in 2023? What we've seen is basically a transition from nominal to real activity growth. And that's exactly what I expected from the second end of 2022. And it's still ongoing, both in the US, as you can see on chart 19, which is considering the New York Fed survey. And you can see that real earnings expectations are still catching up to, what really describes a very strong labor market, because the probability of losing a job has basically never been so low, according to consumers. The same is actually true in Europe. If you're looking on chart 20, which is, again, taking data from European Commission's consumer survey. So here I'm really using the leading indicators in the consumer surveys, because I don't think there is much value in the headline, but a lot of value in the right details. And you can see that real income expectations have recovered and are still rising in the Eurozone, which means that, the sort of like flash recession that we had in Europe is probably not going to last. And obviously that's the reason why equities are still making new high, despite the fact that many countries have had 2 consecutive quarters of negative growth.
Okay, Juliette, so you're saying that central banks have actually unleashed positive real demand forces by weighing on headline inflation.
Right. That paradoxically and against all common sense, that's exactly the point, Eric. The bottom line is that monetary tightening has done the opposite of what central banks wanted. It's lifted rather than constrained demand and created an economic sweet spot. Now, that is obviously just temporary, but that's the story of 2023, at least the first half. Into H2, nominal wages should level off. But secular labor market tightness means that wages may have enough inertia to continue beating inflation expectations, and that would raise hope for further real income gains. Such a fit will inevitably keep final demand elevated and possibly delay the return of inflation to target.
Okay, Juliette, but so far we haven't had any discussion of the most expected recession of all time, which has been everybody's favorite story of 2023. So is there still going to be this most anticipated recession of all time? Is it still coming?
Well, I mean, a recession is always coming, but obviously the main question is when. And there, I'm absolutely convinced that the answer will be in wages. Beyond 2023, and perhaps before then, and this is obviously something I will monitor closely for JDI clients, the fun part of disinflation will actually end. And unfortunately, the unpleasant part will start. The unpleasant part is wage growth catching down to stabilizing inflation expectations and ending the economic sweet spot. And by then, the lagged effect of overly tight monetary policy will hit demand with full force as the effective mortgage rate, for example, finally catches up on the current mortgage rates, like you can see on chart one. At that point as well, and that's a really important thing, is that the US credit impulse, which I charted on chart 22, will start to matter again. So what we've had this year was a temporary disconnect between aggregate demand and credit. Simply, demand didn't need credit. But with real purchasing power gains in the rearview mirror, the credit drought will hit aggregate demand. Again, that's on chart 22. And lastly, I'm looking forward to the update of the chart 23 with Friday's non-farm payroll. But my expectation is that US rates are unlikely to hit 6% because real wage and incomes are really still only normalizing, and the Fed still really doesn't need to rock the boat. So what you can see on chart 23 is that despite no labor slack, real hourly earnings are still below 2%, which would be a level consistent with the Fed 2% inflation target. So again, let's see what Friday brings. If real hourly earnings like blow above 2%, then that we could see the case for like rates moving to 6%. But really, that's not my base case scenario.
Okay, but when real wages start pushing above 2%, don't you expect a second wave of inflation and the Fed to have to trigger a hard landing this time?
That's obviously the $1 million question for 2024, and one that actually has to consider the AI era as a macro game changer. You see, I've written a full report on not on AI itself, but on the macro ramifications of cognitive intelligence supply exploding with the AI revolution. And I reached very different conclusions than consensus. My view is that while this revolution will see a productivity explosion, firstly, it's likely to be just a one-off, but more worryingly, it is likely to cut short the budding virtuous wage cycle for workers. So what you will do is basically inject, tremendous capacity in terms of cognitive intelligence. And the reason is that the one-off formidable productivity gains as a result will shift the global distribution of income further towards businesses and elite workers. So sure, the good news is that inequalities will somewhat rebalance around the median wage in line with a shrinking intellectual versus rising emotional intelligence premium. And what I'm talking about there is basically lawyers and bankers will be worth less, but potentially nurses will be, or carers generally, will be worth more. But on the whole, it is really the dividends paid by a handful of mega cap big tech companies that will mostly benefit. And as a result, the new defensive trade, I think, will become long NASDAQ versus long tips, which is actually what I've been recommended and continue to recommend. So for me, it's sort of like the new risk parity portfolio, because obviously AI is injecting a new asset class of like a ultra long duration in the US indices. And on chart 24, you can see that the tech-driven productivity revival which finally will be on the way, is not likely to benefit living standards. And that's, in fact, exactly what happened with the internet revolution. I think the AI revolution will be like the internet revolution, but basically like with a massive compounded effect. So I think that aggregate demand will start sinking again going forward without the need for substantially higher rates. But obviously that will depend again on the state of the labor market and how fast we can be replaced. In fact, more likely than greater than expected hikes are greater than expected cuts ahead, because lower inflation expectations and fading real income gains will lay bare the fact that interest rates are already 75 basis points too restrictive and likely to become even more restrictive as inflation and inflation expectations fall. And to show that using a modified Taylor rule, which is taking inflation expectations instead of like headline inflation as an input. And you can see that, for the first time in the whole history of the index, it's actually showing that, cuts are already needed.
Juliette, thanks again for another terrific slide deck. But, you really piqued my curiosity when you mentioned that your report last month was on artificial intelligence, a subject that we've been looking very closely at here at MacroVoices. I know that out of respect for your paying customers, you can't share that entire report with our listeners. But how about giving us just a kind of a high-level overview of what your views are on AI and particularly the risks inherent to it? Should we be concerned that AI is going to be do more damage than good to the global economy?
So, on that first point, my view on your last point, my view is clearly that, you've got two possibilities. Basically, either humans fall in love with robots, which is possible. I'm citing reports in my JDI research that show that basically a medical robot has 7 times more compassion than an actual doctor. So this is clearly an issue. And for example, in Italy, they've basically got robots to help taking care of old people, and it's been so far quite successful. Obviously, China has also deployed robots to teach kids, and they're able to read how bored kids might be in their iris, and basically change the program according to that. So eventually it is possible that humans fall in love with robots, and that my view of an exploding emotional premium will in the end be wrong. But if there is an emotional premium, what you will see is basically workers in all care sectors, but basically anywhere where you actually want to talk to a real human. And there is still a lot to say about the fact that humans are made to connect with humans, and this is actually what brings happiness. So my view is that the same will happen as what happened with the internet revolution, where you had prices collapsing in goods, for example, but the money and the profits made and the productivity gains in those sectors that benefited from better distributions basically created a pool of money that translated it into much higher prices in everything that wasn't created by internet. And in that case, it was education, medical costs, obviously housing, and etc. So I think the risk is that the same thing happened, and that the productivity gains that you're getting in banking, medical sectors, law, actually produce another pool of money that will translate and basically blow a bubble in anything that cannot be produced by AI. So that could be an emotional premium, but that obviously also will relate to anything that cannot be produced by AI, like commodities, land, and obviously in the end, real estate as well. So just to be short, to summarize on your question, I think if humans fall in love with robots, then we can get like massive productivity gains and overall have like much higher productivity globally. But if that's not the case and there is an emotional premium, the only thing that will happen is basically anything that can be produced by AI will become much more important as a part of the economy. And by design, that's going to be sectors that are going to be low productivity sectors, which means that overall, we will end up with, on aggregate, lower productivity. And in the end, lower living standards as well.
Juliette, as a final topic, I'd like to move on to the situation that's evolving in France right now. As most of our listeners know, you live in London, but you are French in terms of where you grew up and where your family is. Obviously, you've got some very strong connections there. The sensationalized Western media has told Americans that France right now has devolved to an absolute war zone. You couldn't go there without weapons and flak jackets. I'm guessing that's probably more press exaggeration than reality. What is the real situation on the ground in France? How bad is it, and when's it going to get better?
Right. So just to soothe your listeners, you can totally go to France this summer and you will not see war on the streets. That being said, the situation is very serious, and it is intrinsically linked with immigration and the fact that drug dealing is not contained to like Paris suburbs anymore, but has actually like spread to the rest of France. So there is a growing number of lawless zones where drug traffic is exploding, not just Paris. So it makes it more and more difficult to manage. But what I really want to say is that the constant near state of emergency in France is also no question linked with inequalities and what we've just discussed in that report and what may be aggravated by AI in the future. And that's obviously a subject that French people are extremely sensitive to, and much more than Anglo-Saxon countries, where inequalities are actually much higher, but people care less. I mean, this is what the French Revolution was about. And I'm afraid that COVID-led inflation and the collapse in real earnings is no question one reason for the deteriorating security situation. I mean, the Yellow Jacket movement was about inflation. In the end, what's happening in France, we are really in the subject of the big macro issues that we've been talking in that interview and which will keep driving macro forces going forward. So I would say, keep an eye on France because the situation is dicey and the riots are not so much about, the killing of Nael. In fact, you ask in the streets, people don't even know why they're ransacking shops, but they're doing it because, there is anger there.
That's a point that's always fascinated me. What goes on in these large group protest situations where people who have, I think, very legitimate gripes and complaints, they've got good reason to be upset. Okay, but what does burning your country down do to solve your legitimate gripe? It seems like that's just a natural human behavior that when people get pissed off, they burn shit down. And they don't really stop and think about whether that helps them or not.
Yeah. Well, unfortunately, I mean, they feel like disenfranchised as well, right? I mean, they vote, but it makes no difference. I mean, in a way, that's the only way they're heard as well, unfortunately.
Well, Juliette, I can't thank you enough for a terrific interview. But before I let you go, I want to talk a little bit more about what you do at JDI Research, because your research notes are famous for the graphs and charts they contain, which everybody loves. Thank you so much for sharing the download with our listeners for this interview. What can people expect to find at JDI Research when they go check out your website? What's the URL and what products are on offer there?
So my website is www.jdiresearch.com. My product has not changed for the last 7 years, but I can ensure you that the framework changes on a monthly basis because, there is no framework that could have called rightly the cycles of the last 7 years. So, I expect that I will not be replaced by AI in the near future, because AI only knows about the past, and I actually try to use my common sense to actually predict what will drive the future. And quite often it's just about getting one thing right. And for example, today we talked about wages. Last year it was something else. You don't need to basically gather 50, 500 a million of data sets to actually get markets right. So my product is about giving you a strong understanding of the current macro backdrop and extrapolate into the future. And I basically also connect the dot directly to the markets, which makes me, different than any economics which will tell you, what will happen macro-wise, but doesn't necessarily know what it will mean for markets. So, I've got on the first page of each report my timely recommendations. I mostly focus on institutionals and family offices. I've had a few happy retail clients in the past, but really my price range is more directed to institutionals and family offices. I mean, I should add that I haven't changed prices for a while. So, I'm anti-inflation, which means that, you get a lot of real purchasing power increase at JDI Research over the past few years.
And Juliette, in addition to not increasing your prices, you've also been kind enough in the past to offer MacroVoices subscribers a discount. What's the story there?
Yeah, that's true. I've done that every year since, I've known you, Eric, and I will continue to honor that sort of, understanding we have. And I'll offer any of your subscribers a discount if they tell me that they come on your behalf or after having listened to the interview.
Okay, folks, we'll be sure to mention MacroVoices so you can get that discount. Juliette, thanks so much for a terrific interview. Patrick Ceresna, Nick Declercq, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great to get an update from Juliette. Now, joining us in the post-game segment is Nick Declercq. Now, let's get to the chart deck. Listeners, you'll find the download link in the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you're not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Juliette's picture saying, looking for the downloads. All right, Eric, let's cover crude oil.
EIA inventory was delayed this week by the American holiday, so I don't have it. The market has drifted back up to the level where it's failed several times previously. So we need a clean breakout above $74 on WTI to signal a new bull trend, and so far, no luck with that.
So, Eric, I put on a tighter 50-day moving average on the chart on page 2, and I highlighted that first quarter of the year trade range, which I continue to think is really important. It's sort of in the 74 to 82 kind of area. And more or less, we had obviously crude oil strengthening off of its lows, but still in a pronounced downtrend. And it's very premature to be talking bullish in any way. But one of the things I will be watching is whether crude oil manages to re-enter that green box trade range zone, because to me, that would get it above its 50-day moving average for the first time since April. And it would be the first time that the bulls would actually have a chance to reverse what's been over a year-long downtrend. Will that happen this time around is certainly what's on my mind. Eric, though, what are your thoughts here on equities?
No change in my view from last week. We're still holding this breakout level well above the 61.8% Fibonacci retracement at 43.09. That doesn't make any sense to me fundamentally, but the chart's telling me that this market wants to rally back toward new all-time highs, so I'm on the sidelines.
All right, well, let's actually get into the levels here with you, Nick. So we have the S&P 500 levels on page 3. What are you watching?
Spot price right now on SPX is 44.50. You have a call wall above at 4,500 and a put wall below at 4,200. The implied move for the July 21st OPEX is plus or minus 80 points. So the upper expected move is 45.30 and the lower expected move is 43.70. Key resistance right now is right above at 4,500. Key support is at 4,400, 4,350, then 4,300. I'm inclined to think we see some downward price action perhaps over the next couple of months, but keep in mind that the first 3 weeks of July, are the strongest weeks of the year, historically speaking. So it's possibly chop around, but I do expect us to pull back down to that 4,350 area over the next month or so. And
Nick, it's interesting that you say that. Like the S&P 500 for me has been in such a strong bull trend, and we had attempted to break out last week to a fresh year high, but so far it's rejected there, and clearly we're weakening this morning on these futures. For me, it's certainly going to be very interesting to see whether or not the bulls can buy this dip, because as far as I'm concerned, if the S&P 500 here can stay above 4420, 4440 in this area where we're almost trading into right now, this is a typical area where short-term intraday swing traders would buy the dip and push it right back to the highs. And if we have any weakness that breaks us down to, let's say, 4400 or lower, then it might usher in the first potential pause in the market advance that could look a little bit like December of last year or February, where we mean revert back down to the 50 or 200-day moving averages. Right now, it's such a critical moment. We haven't no real signal. Right now, I almost assume that the bulls will remain in control, but we're coming to a pretty important point where we're going to find out whether or not they buy that dip. So nonetheless, though, let's move on to the NASDAQ, where that relative strength has been all year. What are your thoughts here, and what levels are you watching?
Spot price on Qs right now is 370. There's a call wall above at 375 and a put wall below at 350. The implied move for the July 21st OPEX is plus minus 10 points. So the upper expected move is 380 and the lower expected move is 360, with key resistance right now above at 372, which is the high from March of 2022, and then resistance at 383. Key support is below at 350. Again, I'm inclined to think that we see some selling in tech and some rotation to the small caps. I'm actually pretty bullish on the small caps going into the end of the year. And I think that the large caps have run pretty heavily. We're seeing Apple, Meta, Amazon, Microsoft, they're all peaking right now. And I don't think they have much upside, especially as we go into the Q2 earnings reports, which will be out in the next month or so. So I'm inclined to think that bearish to neutral on big tech, and I'm more bullish on small caps. IWM, which is the Russell Index, is what I'm looking at right now.
What I wanted to talk about is just how we continue to see such low levels of volatility, considering the velocity of even the rally to the upside and the potential for week by week volatility to even emerge. It really looks like volatility is anticipating far more of a narrow range for the rest of the month. What are your thoughts here on the VIX, and what levels are you watching?
Looking at the VIX right now, we're at the spot of around 15. So this denotes about 1% moves in the S&P each day, roughly. So looking at this right now, we've hit multi-year lows recently. And as we move up to the upside, the way I think of it is that there's no forced action occurring right now, because typically calls are sold against broader portfolios. And so no forced action is taking place. If we get some surprise event, let's say, for example, that the Fed raises by 50 basis points at the next meeting, which would be a big shock to the market, that's where we can see the VIX take off and see a lot of interest in buying insurance in the form of puts on the SPX. So right now, as we sit and watch and wait for the Fed's action over the next 4 weeks or so, I'm inclined to kind of sit on my hands and wait to see what happens. But there's not much to really do right now, because buying premium might be smart over the course of 2-3 months, but selling it short term is not really a great idea overall. Moving on to page 7, we have the US dollar index. What are your thoughts here?
No real change since last week. We're right in the middle of a wide consolidation zone, and only a daily close below 100 or over 105 is going to change that.
Eric, for me, it's that trade range is prevailing. I think we're going to need a big macro event to really drive a meaningful dollar trend. We've seen, obviously, Asian currencies very weak against the US dollar, but at the same time, you have currencies like the Canadian dollar and the British pound that actually continue to do very well. And so it's just one huge muddle, and there isn't one big intermarket catalyst to really drive a meaningful trend here. And And so I, at this point, continue to be of the position that the dollar will bounce around this trade range between 101, 105 until that macro catalyst emerges. At some point, with such low vol in the currency markets, there is potential setup to make some good money when this sets up to break out. But I'm not so sure it's imminent. And so I'm going to be patient and waiting to see where the next major move is. If we see the dollar here reject this 103 area where we're trading, it's not out of line for us to see some short-term dollar weakness back to 101, where maybe the euro heads back to 110, 111 on the upside. But I think I don't see a big US dollar breakdown coming here, at least not yet.
On page 8, we have the gold futures chart, which has shown some weakness recently. What are you thinking here, Eric?
Well, we tested round number support at 1900 and got a nice healthy $40 bounce off of that level. So now it's time to find out whether that was the beginning of a recovery or just a dead cat bounce. I'm leaning toward the latter and lower numbers still to come, and I'm still targeting around 1860, another $50 below where the market is now.
I can't dispute, Eric, that the sequence of lower highs, lower lows, and distribution is dominant. But this exact level where we're trading on gold is of some technical significance to me. I put the descending trend line on the chart to show just how this kind of consolidation wedge is developing. While there is zero technical evidence of some sort of a breakout or a potential trend shift, and the path of least resistance is totally in line with your view, I'll be watching just if something creates a surprise that drives gold to, let's say, break out above 1950, because that could very quickly change the technical flows and the sentiment if we had that breakout. But right now, the downtrend and distribution is the path of least resistance. Nonetheless, I wanted to wrap up things by looking at the 10-year Treasury yields. And we had a substantial breakout above 4% here, particularly after the ADP numbers. And we're slowly approaching the highs from February, March, which were around that 410 area. It'll be really interesting to see whether or not yields go for a full retest of previous highs. It's certainly the weakness in bonds is dominating on the short term, but will it break to a bearish new breakdown in bonds as yields break out to a fresh multi-year high? I'm not so confident about that, but certainly retesting the highs of the yields seems like the path of least resistance. Finally, I wanted to touch on page 10, the 2s10s yield curve on Treasury. Just we obviously back in March had that big spike due to the regional bank crisis, and how quickly we got into this deep inversion back again under 1%, a negative 1% in terms of the deep inversion. We're approached to those March lows again. It'll be really interesting to see whether this trend continues or whether this is where the bottoms are going to form.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, the slide deck for Juliette, and the chart book we just discussed here in the Postgame, and a number of links to articles that we found interesting. There's also a link to a special webinar that I am hosting at Big Picture Trading. The current market volatility conditions make today a perfect environment for a few of my favorite option strategies to hedge or go short the market. Listeners are welcome to register for free to attend the webinar on Tuesday, June 11th, at 1 p.m. Eastern Time. Those of you that don't have access to the link, you can just type in bigpicturetrading.com/money. You'll find that link and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend, that is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.